What hits the markets next is terrifying. I'm Steve Van Metre. Fund managers are selling, liquidity is thin, and retail is about to sell. Now let's turn to the flow show where we found out why you need to sell the rips, because it's not over yet. As we turn to Michael Hartnett, the lead strategist for Bank of America, who says it's time to stay big and sell the rips, because he notes that there's 3 B's right now. That's bonds, base, that's Trump approval, and billionaires. And what he's saying is right now, to see a market rallying, we need the 3 C's. That's China peace, Fed cuts, and a resilient consumer. Otherwise, you need to sell the rips and sell them at every opportunity. Let's take a deeper look as he talks about positioning, because this is important to understand. It's fund managers and they're going to sell. Now, going back to December, they had a record high allocation to U.S. stocks. And on April 15th, remember, that's just a couple weeks ago, fund managers showed a record intention to cut U.S. stocks. Now, you might be wondering, why would they do that? Well, fund managers get pressured from their clients, from their investors, that when they see the market go down, they want them to sell. So right now, fund managers are pressured by what they're seeing coming in earnings with the trade war and what they're seeing from their clients, and that means they're going to sell. And that's exactly what Bank of America is concerned about right now, because liquidity is thin, and if fund managers are selling at the same time retail is about to sell, well, we could see the markets head right back down. And what Hartnett suggests is we need to see, again, the 3 C's, Fed cuts, but don't plan on that happening anytime soon. China peace and consumer resilience. Well, we might get one of those. And the Fed's next meeting is May 7th, where the market's pricing an 8% chance they'll cut. It goes to 65% at their June 18th meeting, and then by July 30th, 100% chance. So right now, the Fed's on pause. But what about China? Well, there's talks about a deal, and then there's talks that there isn't going to be a deal. We don't know, but until that's resolved, look for the market to remain very uncertain and head lower. But what about the consumer? Well, BofA notes that we need to see resilient consumer spending. But what did we find out last week is that we continue to see consumer confidence plunging. We see that income expectations are falling, and we're going to see hours worked get cut. So right now, anything from a consumer standpoint isn't going to keep the markets rallying. But even Goldman gets in on this, as they note in their flow of funds report that they wouldn't jump into the pool yet because, well, it's not over. Now, they'll do note that systematic pressure has finally subsided a bit, and dealers are in a short gamma situation, but the problem is sentiment, and here the big one is liquidity is low, meaning you could see large moves in either direction. And right now, as we look toward the first half of May, it's historically an unfavorable period for the market, and we see a full month of retail outflows, despite the fact we do see dip buying here in the recent past from, of course, retail investors. But let's talk about machine positionings, because these drive the markets and it can drive them in a big way. We can look back to Thursday and we can see the big move in the markets, largely due to machine positioning here. Now, what we can expect over the next week, there is in an up tape. If stocks continue to go up, you're going to see 48 billion of global equity demand, with 7 billion of that going into the U.S. indices. But here's the big one. Over the next month, if stocks rally, machines are going to buy 122 billion of global equities, 25 billion more into the U.S. So if you're worried about missing out on this dip, if you think the stocks are going to go higher, not to worry. We're going to show you the machine positioning here, because they've got a lot of latitude to buy. Let's take a look at their trigger levels if we flip over to a chart of the S&P 500. Here's what you can see happen on Thursday. The machine started to short cover, and that went into Friday. The next level just above here, but if we continue to see fund managers selling and this level isn't breached, look for this to roll over. And what's going to happen is if it closes back below that lower orange line, it means the machines are going to go back into a short position. And this is why BofA is telling you to sell the risk, because fund managers have a lot of equities to sell. You don't want to go major long until we get a substantial close over that second level, and then a breakout over the third one means we're off to the races. But when we talk about overall systematic position, you can see the machines have front run this market. Again, this is what Bank of America is warning, because liquidity remains fairly low here, and that's one of the challenges we're facing. When we look at liquidity, it got as thin as $1 million. I mean, if you traded more than $1 million, you were moving the market. Now, in a liquid market, you want to see that number being over 8 million. Right now, it's in the low 4 millions, suggesting that if fund managers want to sell, they're going to shove the market to the downside. And May is historically a month of the largest outflow for retail investors who have been aggressively buying the dip as they now look to be sellers. But there's some good news as the buyback blackout window has now officially come to an end. And on Monday, we're going to see 30% of the S&P 500 in an open window. But keep in mind the April to May corporate repurchase window is historically strong, but it doesn't get into full swing until sometime in mid-May. So if you're looking to chase buybacks here and hoping that that pushes machine positioning into a buy situation, well, hang tight, because if retail sells and fund managers sell, we could see a double bottom. And that's something we want to look to market breadth here, because not only do we like to look at machine positioning, we like to look at the technicals and momentum each and every week of the broad equity, bond, currency, and commodity markets to help you make more money trading and investing. Let's take a look at the breadth on the S&P 500, and we see that right now about 34% is trading above its 200-day moving average. But when we look back, you can see events where the market has sold off very quickly. Maybe something in the plumbing has broken, something around the world has changed, and it causes a rapid sell-off, and then that gets bought. But there's a lot of times where you see double bottoms here, where you know that it comes down, people get excited, they buy back in, and then you see sell the rips as BofA is warning about. And right now BofA says this is one of those events. So hang tight. If you're looking to get long the major indices, you may want to hang on, because right now we still know momentum is negative. At least the trend is down. We can see, of course, the RSI is above 40. MACD's got a positive cross, and we can see that our momentum timer probe that tracks momentum with a trend overlay is still saying this is not the bottom you're looking for. But one thing we can notice, machine positioning on our fast algorithm is suggesting that the machines are going to buy, but you'll note we have not told our subscribers to buy into this market. We just don't think this is the right time yet, because we subscribe to BofA's view that there is going to be a likely another move down in the markets, and this is one time you might want to sell the rips. But again, want to know from you, are you selling the rips, buying the dips? What do you think of the major indices? Weigh in the comments below, because let's take a look at the charts here and see what's going on with the S&P 500. And one thing we were worried about last week, and why we told our subscribers not to buy in, because it ran into resistance as its 21-day moving average here in red. And right now above that, you've got the 200-day and the 50-day. And here's one of the problems is if you see a market sell off, rally and get rejected at a major moving average like the 200-day, and then it rallies back into it and it gets rejected again, you're now at the beginning stages of an all-out bear market. So this is a big concern here. So technically speaking, the RSI and the MACD are trending up. Buyers are trying to come in here, but remember, liquidity is thin and there's still a lot of selling left to come. Let's take a look at the tech companies here, because we note the same situation here is you want to look for periods where breadth pulls down and then rallies up and pulls back a second time. There are periods, again, where you get sharp sell-offs, but this doesn't look to be one of those, mainly because what are we focusing on right now? It's the 3 C's. We need to see a deal with China, we need to see the Fed cut, and we need to see consumers being resilient. There's one of those could happen, and that's China. Right now, the Fed's not on tap to cut, and consumers are not looking resilient at all. Let's continue and look deeper here, because we see momentum is still negative. The relative strength index at 54, that's positive because we see it over 40. The moving average convergence, divergence, that's got a positive cross. But look, our own momentum timer pro, once again, 45 consecutive daily sell signals. And if we look at machine positioning, you can see we accurately predicted the machines would be buying here. How do we do that? Well, we run a historical overlay on machine positioning. Now, whether or not you want to beat the machines or you want to trade momentum, we do them both each and every day for our subscribers, and you can join us with that. There are links in the description below. And here's the best part. There's a coupon code for a free 30-day free trial. If you want to see how we trade these indicators and win, and how you can too, jump on board with us, because let's take a look at the NASDAQ here. Then we're going to look at small caps, because we see the same setup here. Once again, a lot of buyers came in. Right now, the trend is still down. We're rallying up, looking to perhaps see a rejection at the 50-day, maybe even the 200-day moving average. At this point, it's just a technical rally, because the trend has not changed here, and that's the risk we're facing with the markets. Let's continue and look at small caps, where I've previously said I think this is the biggest opportunity, but we're not there yet. And you can get some indication here when we look at breadth that is starting to roll over. And that's exactly what you want to see. You want to see breath come down, bounce as people come in, and then you want to see the pros selling, and that's where you want to buy. Let's take a deeper look. Momentum still negative on IWM. What do we see? RSI at 51. MACD's got a positive cross, but just because we're seeing the technicals bounce, the trend is not validating. That is the big risk to the markets right now. Once again, our machine positioning leading where the actual machines are trading, giving our subscribers the edge. And again, you can join in with us to grab those links in the description below, because what we see here with IWM is it's coming out of the supply zone. You see the technicals are rallying here. There is some upside potential to get into this upward supply zone, but what do you have the risk of? The 50-day moving average is trending down. You see the 21 days trending down, and you've got overhead the 200-day moving average and a downward trending 100-day moving average. If you want to see an up market, let's zoom out. And what do you note is that price has to move through a slightly downtrending moving average. But what do you get with it? A rising 21-day, a rising 9-day, and a rising 50-day. You'll note we don't see that right now. And that is, again, the risk to the markets right now today. Let's talk about crude oil, because machines are pretty short on crude, and the market is saying, well, you don't want to be long this, but the chart may suggest otherwise. Now, we don't have a position on XLE, but we have a position on another one for Monday for our subscribers. You want to check that out. Here we see momentum again negative. The RSI is over 40. We want to see that. MACD positive cross, but this is about the trend, my friend. And trend is not validating. Machine positioning max short, momentum still very, very short here. Let's take a look at the charts, because we do see some upside potential. It's not flagging on XLE here, but we did put another position out again for Monday to our subscribers. What do we see? Momentum rising now. Why do we think there's something coming here? Let's look at the 10-day chart, and what do you see? The 10-day volume profile. What is this telling you? Underneath here are nothing but buyers, but we zoom out to the 30-day, and we don't see quite as many 30-day volume profile being above. How about the 90-day? Still above. We want to see a little bit more here, and the 6-month is well above. But right now, what we're seeing is a strong amount of volume, a strong amount of buying, and what looks like an early trend. This isn't the trade we told our subscribers to take. We told them to take something else. And again, you too can join, because right now we did say to buy the banks, although the news says not the time to buy, but the charts say it might be. And we put a buy and open on our CTA Time Pro subscribers for XLF. This is a trade for Monday. You can join it right now without subscribing. And when you start making some money, we want to see you join us, because machines here are buying the financials. And let's take a look at the chart of XLF and see what's going on, because it looks pretty good, at least in the short term. And why is that? You can see it's holding this supply zone. Now, a supply zone is a place where people like to buy or sell, and we can clearly see they bought here, 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 and they're looking to buy here. The 200-day moving average is rising. That's a good sign. And we see this potentially rallying into the 6-month volume profile. If it can break above that, we're looking at upside at 51.69. Let's zoom into the 10-day, and what do we see? Buyers below here. That's why we told our subscribers to keep this trade tight, because just in case there's a little move backwards. But what about Brazilian stocks? Well, they're taking off, and unfortunately, this is one trade we missed, because I don't like stocks that gap up and move, because when you buy it, it can gap down the next day. It's very dangerous. And here's what we see. The RSI is at 64. MACD's got a positive cross. We've got some buy signals here, but again, we did not tell our subscribers to buy this one, because again, what you see is gap up moves here, and that is risky, because unfortunately, you can see that reverse very quickly and refill those gaps, and we didn't want to be caught in that situation, particularly with a 200-day moving average sitting right here, looking for a pullback before we would actually put on a position here. But what about emerging markets? Well, that was one of the big things for the pros, but right now we're seeing them actually beat the S&P. It's because it's about liquidity. When liquidity comes back to the markets, EEM responds. How about the RSI at 55? MACD's got a positive cross, 21 consecutive daily sell signals here. This is one we did not put a buy ticket on, because again, we're not overly confident, as it's just closing right on a 6-month volume profile here. We've seen a gap up move, a couple of them. Now, if this holds into next week, we'll be looking for a move up here to 45.08, but for the moment, we're holding tight on that one and setting it on the sidelines. But one thing we did add was a position in bonds. Bank of America says you should be long the long bond. And we finally agree. We put a buy it open on Monday to our CTA timer and Momentum Time Pro subscribers with a stop loss of 87.44. We see machine positioning start to flip here. We see momentum and the trend start to flip here. And we like this trade much better than Brazilian equities or emerging market equities. And let's take a look at why, because we can see now the 21-day moving average is bottoming out and turning up, offering some support. There's a 6-month volume profile right here above. But remember that basis trade of the hedge funds? Well, they're back buying, and what we can see here is the technicals are pushing higher. Let's zoom into the 10-day. What do we see? Buyers underneath here. That's a great sign. Let's go to the 30-day window, and all it does is need to crack 90.06, and then you're off to the races. But here's this strong one. Over the last 90 days, this is where buyers are at. Much better technical setup than what we saw on those other securities. Let's continue, because when we talk about gold, well, as trade tensions ease, gold has dropped, and that, of course, for many people is not their base case. They say gold is going higher. Momentum is positive. We have 12 consecutive daily buy signals here. We didn't trade gold, but we did trade GDX. We made some money on that, and that's starting to pull back as well. We see machine positioning long. Momentum is long on GDX. Let's take a look at the charts here. And what do we see on the miners? Well, they're pulling back off of this very red top. You see a lot of sellers dropped in here, and what we see is a pullback. If you want to be long gold or the miners, you want to wait for a pullback here. 41.67 would be a great place technically if price dropped there. You tend to see that happen with the mining stocks as they'll rally up and then pull back. But what about the dollar? Well, could this be the biggest sleeper trade coming? It could be, and I'll show you why. Because right now machines are short and momentum. 57 consecutive daily sell signals. Let's take a look at the chart of UUP, because when this flips, it's going to take off like a rocket. Here we have UUP, and it's come way down to our target zone. We zoom out here to the 2-year chart. We said, look, it's likely to get down to 26.92. Got pretty close to that. And what we want to see is a bottom forming underneath here, and then a potential rally up to 28.25. This could come in the near-term future. We see the 9-day starting to roll over. Volume profile, 10 days underneath here. 30-day? Right underneath. So we're about to get some signal changes here. The dollar, again, could be a fantastic trade setup coming, but you got to be a subscriber to find out. And we also said buy Bitcoin. That trade now up 12.31% to our Momentum Timer Pro subscribers, and we see there being more upside. 78.71 is our new upside target on this. Let's take a look at what's going on with Bitcoin, because GBTC rallied right into a 6-month volume profile. We think there's a little bit more in this push, and if it breaks through there, you're looking at upside now 81.66. And again, this was a technically sound move. We saw, of course, the RSI and the MACD up and the trend up. Told our subscribers to buy right here. And here's the best part. You could have joined them, and again, for free. Grab those links in the description below. Be sure to use a coupon code for your free 30-day free trial, because right now Bank of America is saying sell the rips and wait for the next step. And we're going to be all over that, and we think you can too. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.